Hey guys, did you know that there is actually an ideal amount for every single person to have in pre-tax retirement accounts like IRAs and 401ks in order to generate 100% tax-free retirement income? When I first got into the business of financial advice, I was fully on board with the delay and pray strategy I was taught by the large Wall Street investment banks. Take the deduction today and wait and see what the future holds. A bird in the hand is worth more than... But as I did more and more research, and as tax laws became more favorable, my opinions changed. It's not about paying the least amount of tax this calendar year. It's about paying the least amount of tax over your entire life, especially with the low rates of the current tax code. This is part 3 of the series, How to Create a 100% Tax-Free Income in Retirement. By watching part 2, you learned about the current historically low tax rates and why it is so important to be planning now, no matter what your age. Stick with me in part 3 as we learn how much you should have in your traditional 401k and IRAs at retirement to create a 100% tax-free retirement income. Colin Exelby here, and I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and provide advice virtually to clients all over the country. The overwhelming majority of American taxpayers now claim the standard deduction in their tax return. In fact, the Urban Brookings Tax Policy Center estimates that about 90% of households will take the standard deduction rather than itemizing their deductions. If you have significant medical expenses or charitable deductions, you may itemize, but that list is getting smaller and smaller. For married couples who are both over the age of 65, the standard tax deduction is $28,700 in 2022. This will generally increase with inflation over time and is important to understand because a married couple can currently have up to that amount of provisional income without owing any taxes. Remember, from video 1 of this series, provisional income is 1/2 of your Social Security income. Any distributions from your tax-deferred retirement plans like traditional IRAs and 401ks, any 1099 capital gain or interest generated in your taxable accounts, any employment income, any rental income, and interest from municipal bonds. That means a married retiree could take up to $28,700 currently from their tax-deferred IRA without tax if they had no other provisional income. In this situation, that would mean you get the tax deduction on the way in. You get tax-free growth, and you can pull it out without paying taxes. Triple tax-free. If you're watching this video, you believe tax rates will be higher in the future, so maximizing your planning now while you're younger makes a lot of sense. But how exactly do you design your current retirement savings strategy to maximize the standard deduction? This is a good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. In my opinion, when planning for your retirement, your tax-deferred retirement account balances should ideally be at a level where future required mandatory distributions, or RMDs as they're called, would be less than your future standard deduction. Got it? If you missed that and you didn't understand what I said, just hit that rewind button. Keeping your RMDs below your future standard deduction can potentially make your required distributions tax-free while also not causing taxation of Social Security benefits. Everyone's situation is different, which is why custom financial planning is extremely important. So how do we do it? This concept is actually pretty straightforward, so let's look at a hypothetical example. Marcia and Don are both 55 years old currently. They are 17 years away from mandatory IRA distributions. We are going to take the current standard deduction at age 65 of $28,700 and inflate it by a historical rate of 3% per year for 17 years. That standard deduction will be closer to $47,000 when they turn 72 and are required to distribute from their IRAs. So at 72, if they didn't have any other tax deductions or provisional income, they could potentially take up to $47,000 total from their IRAs without any taxes. But how much will Marcia and Don be required to take? Well, the IRS has a nice table to figure that out. This table is periodically updated, so you want to make sure you're using the current one when working through your calculation. If you're married, but your spouse is more than 10 years younger, congratulations. There's a special table for you. But for this example, Marcia and Don are the same age. At 72, their required distribution amount is basically 3.65% of their account balance based on their divisor of 27.4. Now that we know what they are required to take out, we can calculate the ideal total amount for Marcia and Don to have in their IRAs at age 72. So how large of a 401k or IRA could they have to distribute their required distributions tax-free? Drum roll, please. $1,287,800. You figure that out. In this calculation, $1,287,800 times 0.0365 equals $47,004. Or according to the 2022 IRS table, $1,287,800 divided by 27.4 equals $47,000. They both equal the same thing. Conceptually, a married couple, both over age 65, with no other provisional income could have just under $1.3 million total in IRAs, and the distributions would remain tax-free based on 2022 numbers. This is the starting point for figuring out the ideal amount of funds to have in a traditional IRA at age 72. Even if you had some provisional income, like say half of your Social Security benefits, you can create a strategy where distributions are not taxed or are minimally taxed. Just incorporate that provisional income into your calculations. And if you live in a state where distributions aren't taxed, even better. As of 2022, there are 12 states that you could live in that don't tax retirement account distributions. Take that into consideration when you're considering where to live. So this example figured out the ideal number with forward-looking planning. You may be thinking, okay, well, having little or no assets in traditional IRAs and 401ks is also a good move, potentially putting all your assets in other account types and limiting your RMD amounts that way. Well, let's take a look at why this is not a good idea. Let's say Marcia and Don only had $100,000 in tax-deferred IRAs and 401ks at age 72. Their required distribution based on the tables would be $3,649. They would have $43,351 in unused deductions. That would be very poor planning. And if you want to avoid poor financial planning, I would hit that little like button on this video and make sure you smash that subscribe button, hit that little bell so you're notified when I release the new video in this series. In my opinion, to get the maximum after-tax retirement income, you want to make sure you optimize the full amount of your standard deduction. Unfortunately, many retirees do not. Because my industry promotes the delay and pray strategy so much, many people don't plan properly in the earlier years. You figure that optimal number out for your own situation through these calculations. First, take today's current standard deduction and inflate that by the number of years until you reach age 72 with a future value calculator like one from this site, or good financial planning software like this one from Right Capital that I use. That will give you your forecasted future standard deduction when your RMDs start. That will be the ideal amount that you would want to withdraw from a tax-deferred IRA or 401k to minimize or even eliminate taxation of required distributions. In order to figure out the optimal amount to have in your tax-deferred retirement account, you would take that ideal distribution amount and multiply it by the retirement factor at age 72, which in 2022 is 27.4. That will give you your ideal tax-deferred retirement balance at age 72. Now, investment returns, RMD assumptions, and tax rates do change over time, so this is a living, breathing strategy that you would continue to monitor. It is not set in stone. Rather than delay and pray, plan optimally for your future. This is a video series about creating a 0% tax bracket in retirement, but you may have other provisional income that makes that impossible. Don't worry. The goal of financial planning in many cases is to maximize your after-tax income and wealth to reach your personal goals. Even if a 0% bracket isn't achievable in your situation, the upcoming strategies can still be used to drastically reduce your taxes in retirement and maximize your after-tax wealth. When you do that, you reduce the risk of running out of money in retirement, and you maximize the legacy you leave behind. Don't spend years accumulating assets just for Uncle Sam. All right, now that we know how to calculate the ideal amount to have in tax-deferred retirement accounts, watch this video next, part 4 of the series, How to Create a Tax-Free Retirement Income, to learn why the Roth is so important to a retirement plan. Get clear? Be clear.